How are you, Nella?
Pretty good, pretty good. Our sip and share was such a success because I was able to convince Alfred to join me.
That's good. Well, it's good that we have both of you here because you're both rock stars.
That was just a huge success, not having anything to do with me. That was a huge success.
Hmm.
In
Yeah.
what way do you define success? Help us understand what happened.
Well, first of all, we were sold out, I think, a week before the event.
Yeah.
So we went, it was just such a beautiful setting, live music, hors d'oeuvres, a caricature person, drawer, artist, um, open bar. It was just really a lot of fun. Got to commingle and just meet a lot of new people.
Wonderful. How many people attended?
I don't know what the sellout number was. It
I
was
think our cap originally was 50, but we might have
We
raised it
paid
a
for
little bit.
extra and I think we ended up with 60 people because we paid for 10 extra.
Oh, okay.
Terrific.
Yeah. So that's
It
those are
was really
big.
nice. It was just so Melissa Falcone, she's just like a host, that it's easy for her. Like she makes it look easy.
Yeah.
Well, welcome everyone to our October Grand Rounds. Before we get fully into our presentation, we have a quick message from our sponsor, um, SoberLink. We'll take a look at that here real quick.
Real or false claims of alcohol use can further complicate divorces by impacting child safety and trust between parents. SoberLink offers proof of sobriety at your fingertips so you can navigate custody cases confidently. With the push of a button and a single breath, SoberLink confirms the tester's identity and sends an instant notification of whether or not they've been drinking. Most importantly, it's so easy to read the court-admissible evidence of a parent's entire monthly testing history, the #1 alcohol monitoring solution in family law. SoberLink.
So we thank SoberLink for their sponsorship. And if you don't know about SoberLink, we encourage you to set up a meeting with them, get to know about SoberLink more. They're very friendly people. They have a great product, and they're wonderful sponsors of the FACP. So we want to make sure that we are, taking the time to recognize all that they do for FACP and the family law community. So at this time, we are going to have Marianella Collado and Alfred Zeiler presenting our October Grand Rounds. Marianella is a certified financial planner and certified divorce specialist who works with high net worth individuals, business owners, and families. She's a graduate of the Hunter College with a degree in accounting. Marianella is an active member in organizations such as the NAPFA, the FPA, the AICPA, and FICPA, as well as with the Collaborative Family Law Professionals of South Florida. She's fluent in English and Spanish, and she brings passion, kindness, and a commitment to lifelong learning to her work. Outside the office, she enjoys weightlifting, pottery, and gardening. We have Alfred Zeiler, who's the founder of Florida Forensic Accounting, where he provides ethical, high quality forensic accounting services with a personalized approach. His practice focuses primarily on family law matters, including cases resolved through litigation, mediation, and the collaborative process. Alfred has extensive experience in business valuation and economic damage analysis across diverse industries and has been published in multiple professional journals. A frequent lecturer on valuation and economic damages, he is active in several professional and collaborative organizations, including the Collaborative Family Law Professionals of South Florida, where he serves as the treasurer. Alfred lives in Plantation with his wife, where they enjoy gardening, home projects, biking, traveling, and sharing good food and wine with family and friends. So we give it to Alfred and Marianella to present the taxing aspect of divorce.
Just a quick
Ex
correction. I'm a former treasurer. Marianella is now the current treasurer of the Broward Group.
yes, yes, a role I absolutely love. Under our fearless president Tammy. Welcome everyone. We're excited. We put this presentation together just to help illustrate. Are you guys able to see my screen? No?
No,
No.
sorry, you need to reshare because I had to
Okay.
share it.
Okay. So I go. So we put this together because we think it would be a nice way to kind of show some of the value that we're able to contribute to the whole process when someone like Alfred and I get to work together because we bring different set of skills to the whole process. And sometimes that is the confusion. Like, well, if I have Alfred, why do I need Anella? Right? And what role does Anella play in the whole process that Alfred can't handle or can't address,
Yeah,
and
we're
vice
both
versa.
CPAs. Can't we both do everything?
Exactly. And that's the big misconception. It's like
Yeah.
in public accounting, right? You're a CPA, oh, but there's audit and there's tax, right? I wouldn't touch audit with a 6 foot pole, and people in audit wouldn't touch tax with a 6 foot pole. So we thought this would be a nice way to kind of illustrate the whole process, like how it goes from what Alfred puts together to the information that comes my way, and then kind of the analysis that hopefully is super helpful for the client to help them reach that finish line. And I think sometimes what we have found, and Tammy might be able to add a little bit more color to that, but especially when you have a spouse who might be a little less comfortable with finances, I'm going to say the less financially literate spouse who's, maybe stayed at home, never really handled the finance, kind of giving them comfort that the things that they're agreeing to will actually work in their favor, and that someone's had kind of like, someone's been in their corner reviewing things and making sure that nothing falls through the cracks, and the tax characteristics of things are in their best interest. So we're going to go through that, what it is Alfred does, what it is I do. Everyone ready? And we
Buckle up.
hope to make this interactive, please. So don't just let us talk the whole time. So if you have questions, please chime in. Okay. I have to put some disclosures just as a financial advisor. We are a registered investment advisory firm. All the information that I will be providing is generic advice. Obviously, before anyone implements it, I have to recommend they speak to their CPA. So this is just a disclosure. This is general information. Well, Eric took care of the introductions, so I'll move on. All right, so what we're going to cover is really kind of cover what are the two roles. What is the role of the forensic or in the collaborative setting, the financial neutral, versus someone who comes in as the financial and tax planner or an allied professional in the corner for one of the spouses or for both. I've had cases where they've asked me to give them both advice, and I have to just make sure that they're aware that I'm going to make sure I disclose, this is good for you, but maybe not as good for you, right? Kind of just disclosing how things affect each of the spouses. But I think it is important that when I sit as an allied professional, that the other spouse knows that if I'm just working for the spouse, that's my job is to look out for the spouse. I had one recent case where the other spouse felt like, well, she's not being neutral. No, I'm not. I wasn't hired to be neutral if I was hired to work with one spouse. So that's something that should be, clear from the onset. And we're going to go into the tax return. I, as a CPA who spent many years in public accounting and doing tax work, I'm a recovering tax preparer. I thank God every day I don't have to prepare taxes and deal with tax deadlines. But I think there's nothing more critical than diving into a tax return to get a lot of insight on things that affect clients. And hopefully, I'm going to help you all look at a tax return in a brand new light and really embrace all of the numbers on these forms. Um, and then I'd like to walk you through a sample checklist, which kind of just complements, it kind of puts together everything that we would have discovered during the planning process of the divorce, and just highlights like a checklist so that whoever's drafting that separation agreement will make sure that a lot of these items are addressed. And this way, what you'll find is that that final collaborative separation agreement will be so beautiful and so complete that if anyone's asking a question on, well, what were we supposed to do with these carryovers? It's all been outlined in the separation agreement, because there's nothing worse than finding yourself a year or 2 years in wondering, well, who's entitled to that? You know, who's going to pick up this loss that was on the joint return? So it kind of outlines a bunch of tax related items for the person drafting the separation agreement to take into consideration and incorporate it into the agreement. Does that sound like a fun agenda to everyone? Alfred, so why don't you walk us through your side here? What are some of the things you like? Where does you start, and then where the handoff is, or where I'm brought in?
Well, so a lot of this stuff that's on this slide, most of you already know. This is kind of what the financial neutral does. Looking for assets, putting together financial affidavits, equitable distribution, income determination if they own their own business, because we've all seen the what I'll call non-business related expenses being run through the businesses. What I find the most interesting on this slide is if you look at both columns, they are completely different. There isn't really one thing that we do that's the same, other than review the tax returns, but we review them for almost different purposes. So this is what's just so unusual, I guess, when you have two CPAs. And CPAs, we think that means can perform anything. And there are some CPAs that believe that. I for one do not. I know Marianella doesn't. I like to stay in my lane. I know Marianella likes to stay in her lane, and we can pass off between each other and just stay in our lanes. And if you look at this slide, you'll see that our lanes are very different. And naturally, when we get to a spouse that is receiving a large amount of money, they're not very financially savvy, they need somebody other than me. Because if you look at the initials or the designations after the CPA, that tells you a lot about the specialty of that CPA. And Marianella's specialties they're not my specialties, and vice versa. So I don't even pretend to be a financial advisor. Probably the biggest disservice that accountants do, that forensic accountants do, and this is going to shock some of you, when we're in meetings without a financial advisor and the attorneys want to know what's a rough idea of income. And as accountants, again, we think we can do it all. We say, I don't know, 4 or 5% income return. We throw that number out and we start coming up with support scenarios. And then it goes to Marianella and she's like, whoa, wait a minute. What are you guys talking about? It's not all just income. There has to be some growth, otherwise they're going to run out of money. There's a lot of different, there are so many different aspects of what she does that we don't consider in the divorce, and just naturally don't. They get this money, there's an income return, we figure out what the net support is or the net need, so we know what the support is, and we're done. But that's clearly not what should happen.
And that's an excellent point. And listen, I always say that more brains is better, right? Kind of taking different perspectives. And sometimes people, right, we all learn and take in information differently. So you might be explaining something to a client thinking, well, this is how I know it to be, this is how I'm going to explain it. But getting a different perspective and a different angle to explain it to the client might be just exactly what the client needs to feel comfortable again and help them get to that finish line. So when Alfred finishes his part of the work, which usually comes up front, right, kind of pulling all that data and building his beautiful equitable distribution schedule and his estimates for alimony, then this information is given to me. Now, what I'm going to do is not only do I have to take this data and start building some long range models, but then I'm going to dive into some of the tax aspects of what the clients have going on. And what we have found is sometimes there are some big surprises. One of the things that Alfred mentioned up front was, business valuations. We had a client, as an example, where the husband had put together the balance sheet, and on the balance sheet, was the name of the business. It said $10 million. And so I remember saying, well, what is that? Did you get a valuation? And they said, no, that's the cash in the business. I said, whoa, whoa, whoa. I said, that cash in the business, you're already entitled to half of it. What we need is a valuation that's driven by other points of data, right? We have to look at income, what's the multiple if you were to sell the business. So again, it's just a different perspective on how people are looking at things. So let's jump right in. This is generally what Alfred's beautiful work will look like. This is actually his worksheet for a client. I redacted all the things. So he's going to put together all the accounts, break them out. Is it marital? Then split them. And then I get this information, and then I get to do my work. So generally, and I'm not going to jump into this, we will take this information and start creating these long-term models reflecting if you get half of all the assets and you're getting income of X and you have this type of portfolio and the income that it generates, this is what the probability of success that you'll be able to meet all of your needs on a long-term basis. And usually what we try to do, especially if you have a spouse who's really scared, is I tell them, tell me everything. Let's throw everything and the kitchen sink to these projections to give you comfort. So that's usually step one, is kind of getting them comfortable with a lot of the options that Alfred has already built along with the team. And then presenting this back to the whole team. I remember, Tammy might remember this meeting where we were all in the room and the husband said, well, I propose that we do this. And husband said to me, right, honey, tell her, speaking to me, tell her, honey, that she will be okay. And I said, no, I cannot tell her that she will be okay because I have to make sure that the probability of success of all the models are at least 75%. And then she gets the green light. So then, like real time, Tammy remembers he was able to adjust what he was proposing. So that was really efficient. So going on now to the tax aspect, because this is not tax. This is the continuation. So let's jump in to the return. So I go through every page in the return, and what I'm looking for is what items on a tax return have been considered or not considered either as part of assets or something that needs to be addressed in the separation agreement. So this is page 2 of the 1040. I told you you're going to love reviewing a 1040 from now on. If you go to page 2, you will immediately see that this person has an overpayment of $56,000. Which represents an asset, right? So this was payments made to the IRS. So now there's a credit sitting with the IRS because it was all applied to the following year's tax liability to their estimates. So how is this going to be split? Did we take this asset into account in the equitable distribution schedule? Is he keeping all of it, or are we going to go 50-50? So again, just identifying, I'm calling them like either hidden assets or hidden tax benefits in the tax return. So this is every page. I will stop at every page because there's something in every single page.
Yeah, this is one that's frequently missed, Marianella. And just recently in a litigation case, I saw the husband purposely overpaid the IRS by over $200,000 that he would keep as a nest egg. And the judge ordered him to request that money back so that he could pay fees of all things.
Yeah.
So people will try anything.
Yeah. So, Schedule B, this is now where someone is outlining all of their interest and dividends. So, what I typically do, this is like, again, like a second set of eyes, even to what Alfred did. So, I'm going to double check that every item that's kicking off interest and dividends flowing through the tax return has already been accounted on his equitable distribution schedule. And for the most part, Alfred's pretty good. So, he would have gone through them and he caught everything. But I'll just double check that if it's coming through the tax return, and there's one schedule where sometimes things fall through the cracks. So we're going to stop there in a little bit. But just so you know, like my check is that everything that Alfred included on the distribution schedule is something that was also already flowing through as income on their tax return. All right. This is an example of something in this particular case. This client was doing consulting work. This income hadn't really been considered as part of, I think it wasn't considered, but he said he wasn't going to do any more consulting work. But identifying other sources of income on a Schedule C consulting is critical. So we move on. On Schedule D, what you'll find here is any capital gains or losses. So if we have losses that resulted in capital loss carryovers, who is going to keep the carryover, right? So generally, there's also the IRS guidance on who gets to keep what. General rule with capital loss carryovers is that they stay with the person who generated the loss. So if an account was in just the husband's name and that's what contributed to all the capital loss carryovers, well, what is the value of that capital loss carryover? At the very least, those capital loss carryovers are going to represent a tax benefit of 23.8. So how are we giving the spouse credit for a future tax benefit that the client is going to get? I actually had a case a while ago where the husband had all the capital loss carryovers, and then he wanted to just transfer all the securities in kind to the spouse, but she wasn't going to get any of the carryovers. And when I said, no, we should sell it first, take advantage of his carryovers, and then you get the cash because he was going to keep all the carryovers. Either that or you equalize her by giving her some sort of an asset on the equitable distribution schedule equal to the value of that loss going forward. Does that make sense? I know I'm talking. Uh, does that make sense? Kind of looking at the capital. If we have $100,000 capital loss carryover, the value of that, if I take 100,000 times 23.8, which is the long-term capital gains rate, the value of that $100,000 capital loss carryover is 23,800. So how do we equalize the spouse for the fact that the husband will be able to, in the future, reduce his tax by 23,800 from a loss that was generated during the marriage?
Hey, Marianella,
Yes.
what if the parties wanted to split it 50-50? Would the IRS allow that?
Yeah, you can do any allocation that for some of the things you can negotiate an allocation that the spouses agreed upon.
Okay.
So this is Schedule E, another one of my favorite schedules because this will generally show you what business interest the person has that is not a bank account. Could be like a passive investment, could be an active business. So these would be, and in my world, I have folks who have like private equity interests, real estate investments. So again, this is going to be a cross check. If I see that there's a private equity interest, did we reflect that private equity interest on the equitable distribution schedule, and how did we value that interest for purposes of the split? Or how did we take this income into consideration for the whole alimony calculation as well?
Right.
I had a really interesting case of a couple. getting divorced, and the husband owns a 50% interest in a business that generates $1 million of income per year. And the husband is proposing that he's going to pay her 8 years of alimony of 150,000 and be done, and not split the value of the business. And I remember telling the attorney, sometimes we have to step back and think like this is a business transaction, right? Who in their right mind is going to give up a 50% interest in a business that's generating for them $250,000 a year for 150 for 8 years and be done? So sometimes we need to step back from the divorce and say, if this were me and I'm entitled to an asset that's going to kick off $250,000 of income, am I willing to give this up for 8 years of alimony, right? So sometimes just like the labeling of things like, oh, well, here's alimony versus, a 50% of this asset. Well, this asset is an income producing asset. So sometimes just stepping back from the whole divorce world and looking at it as a business transaction. Who would make that deal, right? Deal or no deal? Would you give up a 50% interest in exchange for this alimony payment? So sometimes, looking at creative ways to restructure give up alimony and keep this asset and you're done. You don't need alimony now, but you're going to have this income stream for the rest of your life, potentially. Any
So before,
questions on Schedule E? Mhm.
before we get off of this Schedule E, just a couple of things. The income number on a Schedule E is very rarely the actual income. So please, whatever you do, even if you don't get a forensic accountant involved in a case, please don't rely on that number because it's going to be wrong 99 times out of 100. Another thing, which I'm starting to see a little bit more often, is Schedule E is for like pass-through income from an S corp or some other kind of partnership or some kind of pass-through income. I'm seeing people that have a pass-through entity, but then they also have Schedule C income. Schedule C income is business income to the individual, not through a corporation, not through an S corp. And some people are not very bright because they take the same expense twice. They're double counting. And I recently saw where literally this guy took a $2,000 office expense on his business tax return, and then on the Schedule C took $2,000 of office expense. He took the same number, he took the same expenses and just expensed them twice. So what I'm seeing is people are splitting their income between a corporation and then between themselves on a Schedule C, and then double counting expenses. So that's also something to look for. If you see income on Schedule E and C, you really need to take a deep dive into the expenses.
Yeah, and another thing, how is it classified? So is it non-passive? Non-passive would represent an active activity. This is like in this case, this is a physician. He had like a side practice. And so he was active. He was the physician doing the work. So that was non-passive. Or is it passive? Is this just an investment where he put $100,000, but he doesn't do make any management decisions. He doesn't run the business. And then you have to be careful because as soon as you see numbers in these passive columns, that means that you can potentially then have some passive loss carryovers, which we're going to talk about in a little bit, because these were losses that were potentially generated during the marriage, but because you're not allowed to deduct passive losses unless you have passive income, they become a carryover. Again, then you're going to see what is the size of that carryover and what is the value of that carryover, and how is the spouse who's not going to get this carryover, how are they made whole? So 8606, this one was interesting. Actually, a lot of CPAs that prepare tax returns make a mistake here. I'm saying it as a CPA, no offense to CPAs out there. And this is one of the reasons why sometimes people hesitate to do any planning with IRAs, especially non-deductible IRA contributions, is because if this is dropped off the return, you're almost putting the client in a worse position. So let me explain. Um, anybody who works is allowed to do an IRA contribution, right? So if you work, it doesn't matter if you fully maximize your 401k, you have earnings, you're allowed to do a contribution into a traditional IRA. You may not be able to go to the Roth if your income is too high, but you can always go into a traditional IRA. Now, whether you get a deduction or not is going to depend on how much income you have and if you're participating in an employer 401k. So if you do a contribution to your IRA and it is not deductible, you're supposed to track the basis. And the reason why you want to track the basis is because you don't want to do a contribution to your traditional IRA for which you're not getting a deduction. And then if you don't track this basis, when you take that dollar out, you're going to have to pay tax on it. So in this particular case, the IRAs were all allocated to the spouse. That's how she was equalized. So what we ended up doing is giving her all the bases for the IRAs that so that when she pulls out the money from the IRA, it also accounts for these non-deductible contributions that both spouses made. So this is often missed in general, but especially in a divorce case, like who's really thinking about basis in an IRA as having as having value. So for this one, we had specifically put language in the separation agreement that 100% of all the bases in all the IRAs belong to the spouse because the IRAs were allocated to her. So this is really fun stuff. Anyone want to know more about 8606 or we're good to move on?
I don't even want to know more about 8606.
I love 8606 because this is how we do the famous backdoor Roth IRAs. And while that sounds like a horrible procedure, that is probably the lowest hanging fruit for planning that few people take advantage of because that's how you build tax-free wealth. So we're going to move on. All right. We mentioned passive losses before. Alfred, do you want to say anything about this 8582?
I don't like this one either.
I love this one.
So these are activities in which like a taxpayer doesn't materially participate, like real estate, they're passive, limited partnerships. And these losses are suspended if they lack passive income to offset them. So it's much like the other loss carry forward. These can be done indefinitely, and it's not until they dispose of the entire interest that it becomes fully taxable. I'm sure I'm missing something or not getting everything 100% right on this. I don't deal with this a whole lot, but there's a future tax benefit similar to the capital loss carryover. But this is linked specifically to an activity that generated the loss.
Yes. So this could be real estate. So real estate, by definition, the IRS will say that real estate, by definition, is a passive activity, unless you can and you spend more than 750 hours a year. And so now you could be viewed as a real estate professional. So only if you're seriously managing properties and have the requisite hours to qualify for real estate professional. But otherwise, by default, a rental property is going to be treated as a passive activity. But this could include an investment you made in a private equity or anything that you just made an investment that you're not actively managing and making management decisions within that entity. So as Alfred correctly said, these are going to get suspended and you'll be able to utilize it under a few conditions, either when you have passive income in the future. I used to have my mentor used to say, you need a pig to get a pal. So you need passive income or gains in order to deduct a passive activity loss. So if you have income, you're able to reduce that income, that passive income, by this carryover loss. So in the future, this is all real estate, by the way. So in the future, when those properties are in the black and they're generating positive income, then you'll be able to reduce that income by these losses, or when you dispose of it, as Alfred said. What's cool is you might have like, a property that's generating a profit and one that's generating a loss, and you're able to offset one with the other. But in a divorce, you have to now, who's getting the property? Who does the property belong to? Who's going to get the carryover losses? So that, in this case, we had to go through each property, determine, and actually we found a mistake too, that the CPA had dropped off one of the passive losses from a property that was converted to personal use. But that happens a lot here because the software like drops them off. So if you don't look year to year, you might not realize that you dropped off some passive losses that in the future you'll want to be able to deduct.
Yeah, and these passive losses are typically they would automatically stay with whoever owned the activity, but you can transfer it, and that's when it gets a little bit more difficult. It gets a little more complicated. You can transfer, so the transferor actually loses the carryover if they transfer it to the spouse or the transferee, but the transferee doesn't get an immediate tax deduction. They just inherit a higher basis. So
Correct.
there's no immediate gain. It's just you're transferring it to them for future use. So
Correct.
sometimes there's tax planning involved, like who's the higher income earner, who's going to have the greater benefit, and sometimes that will help determine if someone is never going to have passive income, why give them a passive loss? They're never going to be able to use it, and the other person's not is going to lose it. As to where if you gave it all to the person that can use it, it translates into a bigger benefit somewhere else on the ED schedule to the person that would never be able to use it. So it's
Yeah,
it's always looking forward.
and I love that you said that, because usually our mindset in this collaborative setting is how can we help the family maximize tax savings across the board too? Like, I get it, it's a difficult transition and people might be bickering, but at the end of the day, it's, hey, if you don't plan for it, nobody's going to get a benefit. So why shouldn't somebody get a benefit? Okay. So, other things that are common that are identified just through the process of reviewing tax returns, things that we have found is mistakes on Schedule D. Literally, I had one where the Schedule D wasn't passing my sniff test, and I kept saying something's wrong with the way he reported the stock grants. And sure enough, I kept digging, and I remember this one, the financial neutrals, like, well, how is that your job? Like, that's not your job to look at. I'm like, well, it is my job, because the client now has a huge 50% of the balance due on the return is being allocated to her. And if there's an error that's causing a higher tax liability, I do care about it. So I remember, like, we kept digging, 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 and finally the spouse that wasn't my client called me and said, all right, what is this crazy lady up to? So he said, what is it you're trying to review? I said, I'm pretty sure that the value of the stock grant was included on your W-2, but the custodian, when you sold the shares, didn't capture that basis. I said, so if you can give me all the exercise worksheets, I'll be able to reconcile your bases and tell you immediately if there was a mistake. And sure enough, there was a mistake. And I think the tax went down by like $25,000 as a result of the mistake. Then incorrect filing status. This is a very typical one. Like,
Mhm.
I just had one. They got divorced in 2025. Returns. I'm like, you cannot do that. You were still married for 2024. So just kind of catching mistakes in the filing status, incorrect treatment if something is passive or active. And on that one, actually had a fun case, because this was, I don't know if Neil's on here. He had a client that kept saying that those losses weren't real. and that they didn't represent any benefit because the position was going to be final. And I said, okay, so if it's going to be final, it's still deductible the year that it's final, but what is the basis? And in that particular case, what we found by digging deeper is that it got even worse for that spouse, because they had like a $20 million basis. So that $20 million basis represented $5 million benefit to the other spouse. So as a result of kind of digging deep into that 85, 82 and discovering that that investment that was going to get disposed of had a huge basis that was going to be another tax deduction for the client. So fun stuff for me to identify. All right, so I did want to show you something that I think it's super valuable. Curious to hear your thoughts on it, because what we end up doing, and Alfred actually worked with us on this one. It was nice to kind of collaborate to make sure that all of the things that we identified from a financial perspective, that we had outlined like clear points to be included in the separation agreement, just to like handle all the complexity with all these carryovers and the refund and all of that. So I wanted to show you something that I think was pretty cool, and I'm opening it now to show you the sample because I couldn't put a snippet here. You weren't going to get the best out of it. Okay. So this is a sample of what a typical checklist that we ended up working on for this client. This client was, she was really good with attention to detail. Um, So she didn't want vague language in the separation agreement. So one of the things we did is, she wanted a schedule. So kind of outlining a schedule of what were all the alimony payments, what they were going to be, when it was going to start, when it was going to end. And I had already done all that work because I needed for the long-term projections. So she wanted all of this to be clearly outlined. And just to give her comfort, like it gave her comfort that she was able to go line by line and make sure that things were all captured. This almost became like a large, you know, wish list, if you will, in her mind. And I know in collaborative, you don't want to give them.
We're not seeing the
Oh,
schedule.
sorry. Let me go back to sharing. Okay. Can you see now?
Yes.
Okay, perfect. All right. So this is like our giant checklist, kind of capturing all the fun financial items that we had discussed during the whole process. But you'll see things like, she wanted to be clear on when the deposits would be made. And again, we put this together. It went to the drafting attorney. Some of these things, like she's like, yeah, I'll incorporate this, but this is not, I don't think we should put this. So it was just more of like, things we had captured to, things to present that she may or may not want to include. One neat thing that we did here is obviously a risk to the person receiving alimony is that the payer passes away prematurely. So she was really worried about that. So one of the things we did is kind of do like a backward schedule to show what his outstanding alimony obligations and make sure that he had insurance that was covering at least the outstanding alimony obligation at each point in time. That gave her comfort that we had included language to cover her. Let's see what else was requiring him to have disability policy, naming her as a beneficiary. The quadro language, we like to be specific, like what's getting a quadro, who's going to handle the quadro. So we even put here that, we wanted Matt Lundy to be used so that there wouldn't be any confusion as to who is going to handle the quadro. Let's see. We addressed all the issues on the 529 plan because in this case, the husband wanted the 529 plan to be put under his name. So we identified that if he had done that blindly, he was going to mess up an opportunity that was just provided under Secure Act. So Secure Act is going to allow 529 plan owners to use any remaining balance in a 529 to fund the beneficiary's Roth IRA. But that 529 plan had to have been open for 15 years. So the existing 529 plan was in the wife's name. He wanted it switched to his name, and it wasn't until we brought up the fact that if he did, he was going to basically mess up the opportunity to use any remaining balance to fund an IRA. So then he was okay leaving it in the spouse's name so that they wouldn't lose that benefit. But again, these are things that maybe if you're doing it blindly with the divorce blinders on, you may not think about the impact to something else later on. And then all the tax provisions, we were just as clear as can be as to who would deduct what in what year based on who received the properties, how the carryovers get allocated, um, all the bases, who gets all the bases in the IRAs. So it was just a full outline of things that we absolutely needed to make sure were covered in the separation agreement. And for our client, Alfred remembers, who's so detail oriented, like this gave her so much peace of mind knowing that things weren't getting lost in communication. So that's really it. It's just a sample. I don't know if you've all seen something like this, if you've worked with someone who's put something together like this, but this for our client was super, super helpful. And that's, oh, I did put a snippet here of what the checklist looks like. And that, my friends, concludes the taxing aspects of divorce. Any questions, Alfred? Any thoughts on the checklist? I don't know if you had worked on something like that before.
This one was very comprehensive, and I know you had suggested some language, and then it was given to me, and I, we together kind of fine-tuned the language to make sure it was clear who was getting what, when, how, and it was a real process. And it's funny, this one case encompassed almost everything we covered in this presentation.
Yeah, it was really comprehensive, this case, for sure.
Yeah. And David, just to answer your question, those last slides that Marianella was showing are not part of the slide deck.
Oh yeah, that's just I took the actual clients, I called it a checklist, right? Because I'm not an attorney. I'm not trying to draft an MSA. These were just points that came up during the financial planning process of the divorce that we wanted to make sure were clearly outlined in the MSA. You know, we talked about it, but it's how does it end up on the document that becomes like our Bible going forward?
Ed?
Yeah, first of all, great presentation from the tax point of view. I have a couple of comments, if y'all don't mind, about utilizing a non-neutral financial professional like Marianella. First of all, I'll start and tell you I've had a number of cases with her. She is the best. Okay. But understand two things. Number one, first of all, understand we have really two different types of allied professionals that do that are in Marianella's realm, financial planner. Some are with brokerage houses, and all they can really do is meet with clients. They can't charge them. They can give investment advices. And in certain cases, that's perfect. What Marianella does is provides a service, and her service in cases like you've heard described is invaluable. But I want to give two warnings, okay? Number one is a general warning. When you're using a allied professional, even when they're trained, make sure that they are working hand in hand with the financial neutral, and make sure, I'll put it bluntly, you keep an eye on them. Because underlying all of this, don't forget, they are still they're not a shadow person, but they are a they are another person that's getting into the head of your client without knowing all of the dynamics of the case. So you have to be careful with that. Again, I'll tell you that what Marianella is great about is that if I call her or the attorney calls her and said, "Hey, you may be overstepping a little bit here," she 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 does what she needs to do to make sure she's not doing that. She takes the criticism. So it's critical that you know that. And here's the most important thing I tell you: if you're going to hire somebody like Marianella, do it early, the same way you bring in financial neutral. Because I want you to think about something, folks. Here's where you run into a problem. You've been through one or two team meetings. You're already building options and you have an idea where this case is going to settle. Then you realize, well, my client may need a Marianella to help them out with, how they're going to invest in things like this. And then Marianella steps in and finds lost carry forwards. She finds, some of this stuff that she talked about that you don't typically look for. And it can blow a case up if you're too far down the road. So make sure if you're going to bring someone like her in, do it early.
Yeah, I think that's great feedback too, because then we're all on the same page from the beginning, versus coming in at the end and trying to catch up. So I think that's great feedback.
Agreed.
Excellent. Any other questions? Jeff, you look like you want to ask a question. Oh, you're on mute.
I don't want to ask anything, but I want to compliment both of you. This has been a wonderful Grand Rounds presentation, and it demonstrates what FACP is able to provide to our members. I want to congratulate both of you on just an outstanding presentation, and I look forward to Catherine's follow up for next month. And we should get more and more people attending these. They are educational and dynamic and provide just such valuable information for all of us. Thank you both.
Thank
Thank you
you.
for
Thank
having
you.
us.
Excellent.
Yes,
Well,
want to
that
thank.
concludes.
I was going to say, I want to thank everyone that attended. Thank you, Marianella and Alfred, for this presentation. Thank you, SoberLink, again for sponsoring Grand Rounds. And we will see you next month for another edition of Grand Rounds.
Excellent.
Good
Bye,
weekend,
everybody.
everyone.
Thank you.